Focus. Ideate. Innovate. Enable.
Welcome to the CNBC TV18 Investor Camp, and this time we're not too far away from home. We've traveled to the city of Pune to meet with a lot of investors here. I agree it is a volatile time in the market, so let's find out what our experts have to say about how to wade through this volatility.
So let me start with the first value pick. It's a Cineline. This is not an exhibition company. Don't take this as a media stock. Don't take this as an exhibition company. Don't see this as a a real estate annuity income company. This is purely a real estate stock. The company is owning 9 multiplexes in Bombay. So what is the advantage of each this property is that all the properties are given on a long lease to PVR. But the best part is that those properties are owned by this company because the promoters of this company are the reputed developers of Mumbai, Kankias. And if I take a ballpark estimation, each property is estimated having a net present value of anywhere between 50 crore to 200 crore. Come quickly on the financial performance of the company. If you see for FY16, they have posted a turnover of about 32 crore, which for FY17 will rise to about 40 crore. So coming on this, what is the equity base of the company? 14 crore. 5 rupee face value, net worth is 87 crore of the company. And book value translates to a book value of 31. That means share is now ruling at a price to book of 2. Promoter's stake is 69%. So what my point is that this company will be seen as a real estate company. If you really ask me, maybe all 9 multiplexes which are owned by the company may see redevelopment in the next 9 years or maybe in the next 10 years. So each redevelopment of the multiplex itself will be a independent housing project or maybe the development project in which the companies or in which the promoters of the company are quite capable and quite strong because they sell the property, all commercial complexes at a premium of about 10 to 15%. Those who are familiar with Bombay, they all will know that Kanakias, they are enjoying the good name. So this stock looks good to me at 63. So take a target of 80 rupees in the next 6 months. And I'll advise that keep booking profits. I never propagate the theory of remaining or being a long-term investor. I'm not saying that I'm against that. But if you keep booking profits of 20-30% on an annualized basis also, I think that will keep multiplying your portfolio in a big way. The next stock for the investor is Century Textile. Now let me just quickly go here. People, keep asking me. In fact, we have been recommending this stock. I have recommended this on the channel also many times on CNBC. When it was ruling at around 400-450 rupees in the month of February. Already it has doubled. So somebody may ask me, is it still investment worthy? I would say yes. Because for the simple reason, I just quickly go through their business model. Cement, they have 13.5 million ton capacity. We all know that cement is the hot favorite sector now. Paper company has 234,000 ton per annum. Again, paper is a hot sector, and if you take this capacity of 234,000, probably this is the capacity which is more than that of TNPL, or maybe double the capacity of Seshasai paper, which are all ruling at 300 rupees or 600 rupees, maybe 4 times of quantum paper, maybe of the equal capacity of West Coast paper, because these kind of capacities, these large paper stocks are enjoying. And I don't think that in market, many of the people, they do not know that Century has such a big capacity of 234,000 ton per annum, of which about 36,000 ton per annum is of a tissue paper, which are high margin item. Then they are into textile. They are making denim, second largest or third largest denim maker in the country. They are making fine shirting, suitings, yarn. They have 3 plants, 2 plants in MP and 1 plant in Bharuch. They have rayon division. They are making viscose fiber yarn. They are making rayon yarn. They are making tire yarn and caustic soda. They have a chemical plant also. And last is their real estate. Now this is really a big value creation for the company, which we will be going to see in the next maybe 3 to 5 years. Company is owning about 40 acres of land at Worli, which is a central Mumbai, and they've already started development of that property. They have about 700 to 800 acres in Kalyan. And in the recent AGM, where the company has intended that they want to monetize this property also. So if you take the net present value of all these properties, it is closer to about 11 to 12,000 crores. So I won't take much time here, because quickly going through the financial performance and all that, I've given here estimated EBIT for FY17 is expected to be at 750 crore. Knock off the interest, And then you are going to get an FY17 EPS of about 18 rupees, which alone can come from paper division. Because company is having a debt of about 6,500 crore. So interest burden is quite high, 550 crore. So if you knock off 750 crore EBIT minus 550 crore interest, you get about 200 crore. That's why I've calculated the EPS closer to at about 18 rupees for the whole of FY17. Here I've just given a sum of part valuation, which I've already narrated. Cement, if I value at $100 per ton, while the market is giving a valuation of 130, 140, it gives you 9,000 crore. Paper is again with a EV to EBIT of 13, gives you a valuation of 4,000 crore, 3,000 for textile. So in all, you have the valuation of more than 20,000 crore, while the market cap today is less than 11,000 crore. So I see good potential in this stock. In fact, if somebody asks me, probably this is the stock to have in your portfolio, because a few members here asked me that which are the stocks for very long term. So you can take a view on this stock for next 5 years also, though I've given a target of 1175 in next 6 months, in spite of the share price having doubled in this last 6 months. Thank you very much.
Alright, that as you heard was the master of stocks, Mr. Sp Tulsian. But let's slip into a short break. When we come back, we will continue our stock talk with another veteran, Prakash Diwan of Altamount Capital. Stay with us. Hi guys, welcome back. You're still watching the CNBC TV 18 Investor Camp, and we're here in the beautiful city of Pune. Now, before the break, you heard from Mr. Sp Tulsian about all the stocks that you need to buy in this volatile market. But we're not done with giving stock ideas just yet. Let's listen in to what Prakash Diwan of Altamount Capital has to say.
Investing is as simple as going out on a journey. Let's say you decide when your starting point is, so you know what exactly is your corpus that you have or the surplus that you have. You also know where you want to head, where you want to reach. So that's very clear in a journey. As much as in an investment, your financial goals need to get defined. Now, this is what I'm making money for. You also have to choose, and the options to choose from are a lot when you decide to go on a journey. The same way, investment also has a lot of asset classes to choose. It could be real estate, equity, debt. If you hit the road, very clearly, the first option that you would choose is you take a pre-booked bus journey. You book the ticket online or physically or whatever. There's no uncertainty here. There's a fixed route, there's a fixed fare, no surprises, right? That's what you like about this. It's run by a professional driver, will get to your destination as per the average time, plus or minus a few this thing. This is like your ETFs, your exchange traded funds. There's another option. This is something which we like. We go to Swargate saying, chalo, dekhi jayegi, let's reach there. First reach Swargate and then figure out what's the bus going to Bombay. On the spot. You don't decide, you don't reserve. There's a high degree of uncertainty with timings. It can be stressful and uncomfortable. You might get the last seat, you might get the seat next to the driver, whatever. It might not be what you want. But you have to be lucky to get the right bus. This is what happens when you decide spontaneously on the spot. So this is like equity mutual funds. Everybody talks about mutual fund performance being great, but that's in hindsight. Today you don't know which fund is going to be the best in the next 3 years. So this is exactly what happens when you take a bus journey which is unplanned. And then this is the most exciting part which all of us keep on driving. And that's our own car, but self-driven. That's what direct equity is all about. Highly flexible, doesn't allow you to do anything other than this. So if you really want to make money on direct equity, remember it takes a lot of time, takes a lot of attention. The error of judgment could cost you a lot in terms of delay. If you don't know the route, you could actually lose your way, spend time on the wrong things, and it can get stressful, especially when there's a jam in Lonavala and you're saying, why did I do this? I could have taken the train. That's what, when you realize it's too late. But this is what happens. This is the exciting world of direct equity, which all of us are so keenly into. Now, if you drive your own car, just a few simple rules. Plan your journey well, especially when you go on a journey, you decide on the route map, you decide on the tire pressure, the car condition, and starting time. This is, सुबह 5 बजे निकलेंगे तो easily पहुंच जाएंगे. At least there's more predictability, right? The later you start, the more unpredictable it gets. The same thing is for investing. Decide on the scripts, decide on the investable amount, how much you can spare for what periods of time. Don't, invest short term when don't invest for long term ideas when the money is available only for the short term. Plan that well. start early. Don't waste your time. Just invest. Don't wait for the right opportune moment, otherwise it will never come. Check the weather and traffic conditions. So check what's happening in the global markets, macro factors, sector trends, GDP growth, US Fed rate, oil prices, all of that you do when you invest. Follow the road signs. There are certain simple rules of investing in equities. Don't ever disregard that. And that's the news flow, and that's where CNBC and the entire team come in this thing picture. They tell you exactly what earnings are all about. And don't race with other cars on the road or take shortcuts. I've seen this, a lot of drivers spoil their journey just by doing that, saying, "Usne mere ko overtake kar liya." So if your next door neighbor is invested into some stock which you didn't, अरे मैं रह गया फोर्स मोटर में, उसने किया हुआ है, so you buy force motor at 4200. Don't make that mistake. Thank you.
Mr. Diwan was talking about checking the weather and the traffic conditions. And I think an economist is someone who does that. Essentially, when he tracks the economy, he gives you a broad picture of what's going on at the sector level, at the economy level. Now, if you see the 2016 performance of world equity markets, I've on purpose just chosen the top 10 economies in the world. And you can see a very, very mixed picture out there. So, on one end, you have Brazil, which has given you more than 40% return. On the other hand, you have a country like Italy, which has given you a 23% negative return on a YTD basis. India stacks somewhere in the middle, performing at a rate of 8 to 9% on a YTD basis. India, on a net basis, as I said, offers one of the best growth inflation matrix for overall equity market performance. And if you track how the equity markets have performed domestically, then in the past, anything on the growth side which has been higher than 7.5%, and anything on the inflation side which has been lower than 6%, that offers the best environment for equity markets in terms of annualized gains. Similarly, the reverse tends to happen when growth is below 7% and inflation on the CPI is actually higher than 6%. Thankfully, FY17 is going to offer an environment where growth is moving towards 8% and inflation is actually moving below 5%. Now, having said that, you always need to keep in mind the risks. On the domestic side, I think the risks are far and few. For me, the risks are more on the implementation side and on the gestational nature of reforms, because in case of India, some of these structural reforms like GST, bankruptcy, etc., they would take a lot of time to get implemented. So there will be a gestational period where the markets can get a little bit I would say nervous in terms of that, and the investment recovery so far has been slightly subdued. So that is the only risk on the domestic side. Otherwise, things are far much better placed vis-a-vis the global context. So I think with that, thank you. Best of luck for your investing journey.
Alright, let's slip into a short break on the CNBC TV18 Investor Camp. But when we come back, it will be the most fun part of the camp, our interaction with the audience. Stay tuned. Hi guys, welcome back. You're still watching the CNBC TV18 Investor Camp. I'm here in the city of Pune and we're having a great time. But apart from catching us on television, you can now also catch us on social media. Yes, we have our very own app called the CNBC TV18 Investor Camp app. Just download it and you will get all details about the various investor camps across the country. In the meantime, well, let's also listen in to what the audiences had to say.
I have a question on mid-caps. The mid-cap show which was on CNBC TV18, we have invested in few of them. So I would like to ask Mr. Tulsian as well as Mr. Prakash Diwan that whatever recommendations they have given in that, and generally about mid-caps, should we book the profit at targets or wait after that too, if there are they are good stocks?
If you want to remain happy and if you want to prosper, profit booking is the mantra. This is what I am giving my experience of last 42 years. See, take for instance, in fact, I was just casually talking to a few members here. If you see about more than, I don't have the data offhand, 50% of the stock which were existing in the index, maybe about a decade back, are not existing there. That means at that point of time, they were all blue chip companies And now they are no more a blue chip companies. And many of the companies, like if you recall in the olden days, Sunil Gavaskar joined the company Nirlon. It used to be the prestigious company to work with. Where is Nirlon today? It is just a real estate company. In olden days, it used to be the JK Synthetic. Where is JK Synthetic? It is all got wound up and everything. So what my point is, if you really want to pinpoint maybe 50 stocks which will exist after 20 years with the same kind of growth, maybe 5%, 7%, 10%, if you really ask me, I won't be able to name you those 50 companies, So it is always advisable that keep booking profits. If an expert has given you a target of say X amount, if he has advised you buying at 60, target of 100, set the target of 95. Reduce it, but what generally we do, we become long-term investor when the stock moves to 100. And when the stock corrects to 55 rupees, we start, hunting for the covers and all that. What can I exit? Can I, shift to other stocks? So change your attitude, control your greed and, overcome your fear. So must respect the given target. On the contrary, I would say that slash it by maybe couple of percentage than what has been given. If you are fortunate enough in holding till the target, must respect the target and book the profit. Look for the next round of ideas.
This question is to both Mr. Sp Tulsian and Prakash Diwan. What do you think of Mr. Diwan talked about Motherson Sumi? I'd like to ask him about Bharat Forge, a Pune-based company. Not only as an auto ancillary, but as a defense play.
I think if you've been watching television, Mr. Tulsian has explained in such good detail about Bharat Forge. And some time back we had this whole negative impression about Bharat Forge when the North American Class 8 trucks the numbers started coming down. And he explained very clearly at that point also that this is a company which is very difficult, the business is very difficult to replicate for anybody in that space. So what they are doing in terms of reach, the client quality, the kind of product strength, it's extremely difficult for anybody to generate that kind of business. So it's not a business that you can wish away in a hurry. And the kind of defense play that will now happen, of course, it's going to take a while. It's going to take 18, 24 months for all that to accrue. But I think it's a wonderful business. It's a wonderful company, great management. I don't see any issues for the company just because of a blip in the numbers in America. So I think it's positive. It's just that the stock has run up. Some brokerage house has come up with a 1200 rupee target or something, and that's why it's seen a little bit of momentum. But whenever it is available at dips, you could probably keep on adding to your portfolio.
My question is regarding an IPO. You discuss a lot of IPOs on your side. I would like to understand how to address the issue of an OFS. If you in an IPO there is an OFS and a fresh offer, how would you recommend we analyze that? How do we look at it?
If you go from a retail investor point of view, it doesn't make any difference if it is an OFS or if it is an IPO. If IPO, in case of IPO, the money goes to the company. In OFS, the company goes to the offering shareholder. Now, only concern in case of OFS is when the shareholder is selling some part of his quantity. Because always in 90% of the cases, you see the P investor, the exit is being given to the P investor. Because when P investor is making investment into any unlisted company, there is always a clause that exit will, because P investor is coming in there as a financial investor, not as a promoter. And he wants his return and he wants to go away from that company after a certain period of time, maybe 3 years, 5 years, 7 years. So that exit clause is always provided there, that either promoter will give them an exit or they will be coming out with the IPO, that is offer for sale. Doesn't make, loosely we use the same word for IPO and OFS. So they make that offer for sale by the P investor. I don't see any harm in that. But in generally what happens, suppose take for instance you need to have the 25% dilution for listing purposes in one go. P investor is offering 23%, and to comply with that 25%, 2% is offered as well by the promoters. I don't see it such a serious issue. But yes, if it is a large portion of that is coming as a sale by the promoter by way of OFS, then that's a cause of concern. And in that situation, I will be more keen to know the previous divestment having made by the same promoter at what price. I don't want to give you the instances here because we have been keep covering all the analysis which are all available on our site also in the free section, where we have raised our comment, we have raised our red flag. Because in the recent IPO, again I don't want to name them, the previous divestment was made at a 40% lower price 6 months back. But when you are coming to offer it to the general public, you have hiked it by 40% because the market conditions have started supporting you. Because when they made the divestment to the HNI, maybe 8 months back when things were all turmoil in the secondary market, you made at 60 rupees. And now you are making it at 100 rupees. So the cause of concern is only in the valuations if the sale is made by the promoter. If the non-promoter is exiting from the company by way of OFS, I don't see any problem. We treat IPO and OFS at par.
Thank you, sir.
And with that, it is a wrap on the CNBC TV18 Investor Camp. We had a great time in the city of Pune, but we'll be back soon in another city. Till then, keep watching CNBC TV18.
Focus, ideate, innovate, enable.